Fiscal Policy and the Job Guarantee by William Mitchell and Warren Mosler. A natural rate constraint imposed by the balance of payments. Some economists point to the current account problems that would accompany the higher demand if all the unemployed were absorbed into paid employment under the job guarantee. Lopez Gallardo, 2000, states that advocates of the job guarantee do not address the problems associated with the trade deficit that will probably arise when a policy of full employment in one country is pursued. These limitations may not be significant for the United States. They are, however, of the utmost significance for any other country pursuing a full employment policy." End quote. However, it is clear that this argument applies to any expansion in national income and cannot be related directly to the job guarantee proposal per se. The implication is that the buffer stock of unemployed serves a dual role: to stabilize the inflation rate and to stabilize the current account position. A further implication of this argument is that the deprivation suffered by those in the buffer stock of unemployed is reserved to allow those currently in employment to enjoy an array of attractive and relatively cheap imported goods and services. Footnote 14. Cheaper relative to the same imports at full employment with a depreciated exchange rate. End footnote. The optimality of this position is not established in economic theory. It is illogical to maintain a costly buffer stock of unemployment in order to keep the exchange rate overvalued. If the exchange rate is overvalued and requires low import demand for stability, then increasing the income levels of those currently unemployed may promote depreciation. Expenditure reswitching responses to the terms of trade changes would mean that the fully employed economy would be structurally quite different to the present sectoral composition. Consumption patterns would also be different. In this sense, real incomes of those not unemployed, firms and employed workers, would be lower and those of the current unemployed higher. Economic growth in Australia has long been constrained by the so-called balance of payments constraint. Under a fixed exchange rate, the current account influenced the reserves of the central bank and made domestic expansion dependent on the needs to defend the external parity. This constraint does not apply under a floating exchange rate regime, and domestic policy can thus pursue full employment targets, with the exchange rate taking the adjustment. Mitchell, 1998-2000A, analyzes the consequence for the open economy of the introduction of a job guarantee policy under flexible exchange rates. A once-off, modest increase in low-end import spending is likely to occur because job guarantee workers would have higher disposable incomes. Any depreciation in the exchange rate is likely to shift the distribution of imports away from the low end somewhat, and perhaps increase the contribution of net exports to local employment, given the estimates of import and export elasticities. Dwyer and Kent, 1993, and Bullock, Grenville, and Heenan, 1993. Mitchell, 2000A, has formally tested and rejected various claims that financial markets would react adversely to the initial expansion of the budget deficit. Additionally, international capital now flows more easily to where good returns are expected. It is also likely that a fully employed profitable economy with price stability would be attractive for long-term investors. Mosler, 2001.